All right, we are on the last video of the last chapter of Principles of Accounting 1. If you've made it this far, you should really give yourself a pat on the back because this is not the easiest material. So I give you lots of credit where credit is due. This is hard stuff. It's not intuitive, and so I'm just super proud that you made it here. Alrighty. So I went ahead and wrote some things down, even though this objective goes over 10.4 over natural resources. I wanted to kind of give you a little summary here. We've been talking about property, plant, and equipment, plant assets. Plant assets are depreciated, so we use the terms depreciation expense, accumulated depreciation. Okay. Natural resources are not depreciated, they are depleted. This is just verbiage here. Okay. So it would have depletion expense and accumulated depletion. Okay. Sometimes in natural resources, they'll just credit the asset, which I don't really like. I really like if they keep things clear and they use accumulated depletion. Okay. Then intangibles, which will be in Learning Objective 10.5, they are amortized. Okay. Amortization expense and accumulated amortization. Okay. So let's dive into natural resources. Natural resources, anything we get from the earth, trees, oil and gas, um, diamonds. We live here in Arkansas. We actually have a diamond mine. And if you've ever gone there, it's kind of interesting. I went a lot when my kids were younger, and we had so many Girl Scout trips to the diamond mine. It's really just a big field of dirt. You just dig around in the dirt, which was fun. Okay. So, but they're always going to be depleted. And there's only one method that we use to deplete. We always use the units of production method. Think about it. None of those other methods that we talked about really fit for natural resources. Okay. So our units would be if it's timber, maybe timber per acre, oil might be per barrel, things like that. Okay. So they give us an example here to run through for natural resources. They said an oil well costs 700,000. It's estimated to hold 70,000 barrels of oil and there's no residual value. Okay. So they said around 3,000 barrels were extracted during the year. So here's the first calculation. Okay. We're going to figure out a per barrel amount. We have our cost, residual value, which is 0. And we're going to divide that by the 70,000 barrels that we estimate. Okay. That gives us $10 a barrel. Okay. $10 a barrel. They said they got extracted around 3,000 barrels. So we're just going to take the 3,000, multiply it times the 10. Year one's depletion expense will be 30,000. Do they make the journal entry? Yes, they do. So journal entry, debit depletion expense and credit accumulated depletion. Accumulated depletion is just like accumulated depreciation. It is a contra asset with a normal credit balance. Okay. So I just said that. It's going to look like on the balance sheet, you will see oil reserves for the total 700,000 minus the accumulated depletion of the oil reserves of $30,000. And it has a book value. Remember, that's book value. Book value is just whatever the asset is minus its accumulated depletion, accumulated depreciation, or accumulated amortization. Okay, this is just verbiage now. All right. So now we're going to talk about intangibles. What are intangibles? Well, they're exactly what they say. They're not things that we can touch. It's not a building. It's not, um, you know, anything that's tangible, building, equipment, land. Okay. They're all intangible. I always try to think of like you have the right to do something with an intangible. Okay. So, what are some examples? We have patents, copyrights, trademarks, and even other creative works. Okay. We're going to amortize them over their useful life. Some intangibles have a unlimited life. Okay. We're going to talk about that. But some with if they have a definite life, then they'll be amortized over that life of that intangible. Okay. Sometimes an intangible can be impaired. Okay. This occurs when the fair market of that asset is less than the book value, and then the company will record a loss when an impairment occurs. Okay. So let's talk about patents. Patents is an intangible asset with a federal government grant conveying an exclusive 20-year right to produce and sell an invention. Okay, so this may be a process, product, or formula. The acquisition cost would be debited to the patent account. Patent would be an intangible, a long-term asset underneath intangibles. Okay. So they give us an example here. Assume that Smart Touch Learning pays $200,000 to acquire a patent on January 1st. We're just going to make the acquisition. We are going to debit patent for 200,000, credit cash. Okay. So then they tell us that the useful life of the patent is determined to be 5 years. Usually, there is no residual value on this. This is more like straight line. There could be a residual value, just whatever the problem says. If they don't tell you anything, I would just go with zero. Okay. So they're going to amortize that $40,000 per year, and you are going to debit amortization expense for the patent and credit patent. I don't really like this. I wish they would be consistent and use accumulated amortization. Okay. But here they're going to use patent and be just a little bit different. Um, just read your problems and just kind of read what the problem says. Most of the time, that'll be a little bit clear. Okay. All right. Copyrights and trademarks. These are things like, the Nike swoosh, the McDonald's golden arches. There's some Mickey Mouse things that are copyrighted and trademarked. We have franchises and license. Okay. Franchises, McDonald's is a franchise, Subway, Chick-fil-A is a franchise. All of those things that you could buy into a franchise would be listed as an intangible. Okay. All right. Goodwill is probably the most confusing thing, and we're going to end on the most confusing thing ever. It's really confusing even for accounting majors because goodwill is a thing. We know it's a thing. I think we just, in the accounting world, we can't figure out how to account for it. Okay. So this is not the store, by the way. Goodwill is when somebody pays for, they completely buy another company out, their assets and liabilities. It's going to be the excess over the fair market value of any physical assets. Okay. So they have an example, but I have an example I love and I've been using for a long time. Okay. So we have Sam. We have Sam's Garage. If any of y'all are female, then you can understand why we don't like to take places to get fixed because they look at us and they think we don't know anything and they try to take advantage of us. And there's nothing that makes me madder than that. So Sam's been a great mechanic though. Sam hasn't been like that. He's been great. He treats everybody the same no matter what. Sam has a good name. Sam cannot record goodwill though. Okay. Fred comes along and he's willing to pay $1 million for Sam's garage, but Sam only has $500,000 in physical assets. Okay. Physical assets, building, all those property, plant, and equipment things. things that they can put a value on. But Fred's willing to pay extra because of Sam's good name. So Fred will get to record 500,000 of goodwill. Okay. Goodwill is not amortized for financial statement purposes, but it is amortized for tax purposes. And this has changed several times over the years, and it will probably change again and again and again. Okay. All I have to say is if you are a CPA, if you plan to take the CPA exam, just brush up on goodwill right before you walk in to take the test because you may learn it from me right now and it'd be totally different come time to take the CPA exam. Okay, so they give us an example as well. So this is White Corporation acquired Mocha on January 1st, 2025. The sum of the market values for Mocha's assets is 9 million. Liabilities totaled 1 million. Okay, so their net assets was 8 million and they paid 10 million to purchase Mocha. Okay, so there is $2 million that will be recorded as goodwill. Okay, so let's go through this journal entry. They had, or this is not the journal entry, sorry. The purchase price for Mocha was 10 million. They had assets of 9 minus the liabilities brings that down to 8 million, and we have goodwill of 2 million. Okay. And let's see, yes, they do give us the journal entry. This would be much more complex because these assets right here, we would literally go in and debit the building for the fair market value, the land for the fair market value, the equipment for the fair market value. This journal entry could be huge. Okay. So we're going to record that goodwill. Goodwill will stay on the financial statements. We will not amortize it. We will test it for impairment. And we won't do that calculation in this class because that is actually a calculation. If you're an accounting major, we will go through that calculation of impairment on goodwill. Right now, you just need to understand what is goodwill, how it comes about. Remember, Sam can't record the goodwill. Okay. Mocha is, they were acquiring Mocha. Mocha could not record any goodwill. It has to be a complete purchase and buyout of a whole other entity before goodwill can be placed on the books. Okay. And just some of these assets and their related expenses. This is I've already given you this at the beginning of this video. Plant assets are depreciated, natural resources are depleted, and intangibles are amortized. And that is all for Principles of Accounting 1 and Chapter 10. Again, give yourself a great big pat on the back. I'm super proud of you. I will see you in Principles of Accounting 2.